Welcome to the 3Edge Week in Review for the week of May 8th. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge. Joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3Edge Asset Management. This week, Steve and I will discuss an old Wall Street adage, which I'm sure many of our listeners will be familiar with, and it goes, sell in May and go away. We'll discuss the origins of this familiar Wall Street saying and explore whether it's simply the investment version of an urban legend, a Wall Street myth, or is there actually something to this idea that on average best investment returns occur earlier in the year? First, a brief recap of the activities in the market this past week, and U.S. stocks continued with a familiar pattern, which was sort of up one day, then down the next, and all within a very narrow range. In economic news this week, the Bureau of Labor Statistics report showed the initial jobless claims for the prior week, so it's only a weekly report, but it had risen to the highest level since October of 2021. In addition, we got the PPI report, which is the Producer Price Index, which shows wholesale prices, and they are continuing to moderate. Year-over-year increase in April in PPI was the slowest growth in that wholesale prices since early in 2021. And that just is reflecting that commodity prices have come down and that, perhaps further shoring up of global supply chains. And lastly, obviously in the front of the news this week, President Biden and congressional leaders met to discuss the need for Congress to raise the debt ceiling, with the U.S. Treasury potentially running out of funds as soon as June the 1st. So I think it's safe to say that the debt ceiling debate in Washington will dominate the news in the weeks ahead. One remedy would be to agree on a temporary raising of the debt ceiling, thereby kicking the can down the road, which unfortunately often what happens in Washington these days. So moving on, let me bring Steve into the conversation. So Steve, last week Eric and I went with a somewhat cryptic title for the View from the Edge for May, and the title was Sell in May. And what we were referring to was the old saying, which I mentioned earlier, sell in May and go away. And since it's May, and since I think that there are a fair number of investors who are bullish and a good amount of investors who are bearish, let's look into this expression on Wall Street. Maybe, I think you have an idea of maybe the genesis of the phrase, which is kind of interesting. And just, is there any truth to this? Should we all sell in May and go away?
Well, believe it or not, this phrase was first heard in the 1750s in England. And there was anecdotal evidence all the way back then in the English stock market that it seemed like the returns during the summer and fall months weren't as good as other times. Many years later, this saying picked up popularity in the U.S. And some people thought there was truth to it. Some people thought it was just another financial myth. And yet others wondered, was it just an excuse for people to take long summer vacations? But more recently, there have been some serious academic studies done to see if this is more than just a financial myth. And it turns out that of the average return that a stock market in the U.S. has made over the last several decades, it's about 9% a year. 7% has come from the months November through April. Only 2% came from the months May to October. If you compare that with cash, it says that you could be in equities and earn above cash return from November to April, but from May to October, you were better off in cash. Now, this is, of course, on average. Now, other studies were done to take this to the next level and see, was it a quirk of the U.S.? Was it true in other countries? And one academic study looked at 37 different countries and found that this was a statistically significant impact. It really worked in 36 out of the 37 countries. Now, it doesn't mean it works every year. This is all on average, but there is something to it.
All right. Very interesting. Well, it certainly feels as though as the Fed gets closer to pausing in its interest rate increases, the markets are really in this tug of war between the bulls and the bears. And experiencing, I guess I would refer to as, and have referred to in the past, as sideways chop within this narrow range. So what about doing a little thought experiment here and consider the evidence in favor of the bears who may be tempted to sell in May and go away, and the bulls who are expecting the equity markets to climb higher from here as the Fed begins its pause in terms of increasing interest rates? I mean, the S&P is up over, what, 7.5% year to date, I think? What do you think?
That's right. So, you're right. There's been a tug of war. And whenever there's a tug of war and it results in a stalemate, there's certainly two sides to every conflict. And you're also right that the stalemate has been showing up as the stock market fluctuating, but in a more and more narrow range. And when I've observed this in history, this can continue for a while. But eventually, when it breaks out one way or the other, there could be a significant run as a new set of investors wants to jump in the next trend. So let's first look at the bear case. So the bear case is that so far, what's happened over the last several months is very typical and fits a pattern that's happened many times in the past of a typical bear market rally. Market took a big hit in 2022. We've now had a rally over the last few months, and it's retraced roughly 50% of the previous loss. And now, like many other bear market rallies that have come before, it's about to roll over and go back into the next leg down of the bear market. Another sign that we're closer to the top than the bottom is that the market has what they call a very narrow breadth, which means of the 500 stocks in the S&P 500 index, virtually all of the gains, or almost all of the gains this year in the S&P 500 stock market can be attributed to the 5 leading stocks. Right. The other 495, taken as a group, I think would have lost money this year, or roughly come close to that. So that usually happens near the top, not the bottom of a market. So that's another sign it's poised to roll over. Other measures, based on our valuation metric, the S&P 500 is still highly overvalued. When you look at yield curves, they're still substantially inverted, meaning the short rates are higher than the long rates. This is a very abnormal situation. And every time the yield curve has been this inverted over the last 150 years, it always has been followed by a recession and a bear market, no exceptions. Doesn't mean it can't happen, but it's more strong evidence. More factors. Bank lending is tightening because of all the problems in the regional banks. And now they have to worry about commercial real estate being the next shoe to drop. And a lot of smaller and mid-sized banks own a lot of commercial real estate loans. And so one other factor that's kept the market and the economy more buoyant than people expected, and that's been enormous fiscal stimulus. Well, with the gridlock in Congress and the polarization we have now, the likelihood of another big stimulus package is about nil. So with all these factors, and with many people worried about a recession before the end of the year, this is typically not the time to be investing wholeheartedly in stocks. So that's the bear case. Now let's look over to the bull case. The bulls will say, wait a minute, corporate earnings have been stronger than everyone expected. They haven't been the doom and gloom that people have been predicting so far. Next, unemployment has been lower than everyone expected, and just recently hit another low. It's the lowest it's been in several decades. And that's great news for consumers, and consumer spending has been stronger than everyone's expected. The equity markets are above their 200-day moving average, and usually in a bear market, the bear market rally takes you up to the 200-day moving average and then falls off. Now, there was one important exception, and that was during the Great Depression. There was a fantastic bear market rally after the crash of 29. People thought they were out of the woods, and then, of course, we rolled over in the Great Depression. So it's not a 100% factor, but the bulls will point out that there does seem to be some sustainable momentum. And then finally, there's always a chance of mass psychology taking hold, and we have an echo bubble where the psychology is behind some of these few tech stocks that are really propelling the averages and have become a big part of the averages. And maybe there's a mass psychology that drags the whole market up based on those stocks.
Okay. So, as always, my final question is based on what we've discussed about the phrase sell in May and go away. What might investors do with their investment portfolios? Should they sell in May? And or should they not sell? And probably most important, is there some middle ground here that could make sense for investors?
Yeah, we think it's a big mistake to be 100% invested in the U.S. stock market right now. But we also think it's a big mistake to have no investments at all and to be 100% in cash or CDs, because no one can predict the future with 100% certainty. And there are ways to protect your portfolio and stay invested. So thinking about the bull and the bear case, if the bear case comes to fruition, that represents substantial risk to someone who's overly invested. So we still advocate a defensive posture because we think the bear case has a high enough probability to be seriously concerning. Having said that, we have been able to earn a decent return so far this year, not by being overly aggressive and having all our money in the stock market, but by being diversified in having overweights in a couple of areas that have actually outperformed the S&P 500 index. So we've had an overweight in European stocks. They have done a lot better than people had expected. And our models indicated very early this year to put an overweight in European stocks. And that has really helped. Also, we've been overweight in gold. And so far this year, gold has outperformed the S&P 500 index. So there was a way to be defensive, but still have a decent return this year. And we'll continue to do that. Now, we do have room to get more defensive than we are currently if we find that that's necessary. We're still watching some risky events like the standoff behind the debt ceiling, and how even if it doesn't come to fruition, as time goes by, the markets can get more and more worried. And that in itself can cause a bear market, that just the worry of something bad happening there. Now, as far as fixed income goes, there's some who are now advocating buying long-term bonds. There's some who are saying buy the shortest term treasury bills you can. We think there's a better way to than both those options. One, we advocate not buying the absolute shortest treasury bills, because those are the ones that are in the crosshairs should there be a debt ceiling impasse, and should there be a big hiccup in the Treasury's ability to pay its debt. On the other hand, if you buy long-term bonds, you're actually taking a yield that's below what you could get at let's say, the 1-year level. And you're taking duration risk, meaning that if interest rates go back up again, you can actually lose money. And we don't advocate buying a bond where the interest you get, and right now at the 10-year level, it's around 3.4% or so. The interest you get is below the rate of inflation. That's a way to lose wealth over time. So with the cash in the fixed income side of things, we're saying still be safe, be in treasuries, but the 1-year duration seems right to us.
Excellent. Great. Excellent. Thank you for your insight today into this oft-quoted expression on Wall Street, sell in May and go away. We will have to wait and see if this year proves that the saying is true, or it will be the exception to the rule. So that will do it for Steve and me for this week. We'll be back next week with another edition of the 3 Edge View from the Edge. Remember, all our videos are available on our 3 Edge YouTube channel. And so if you do enjoy the videos, we'd be most appreciative if you consider subscribing to our 3 Edge YouTube channel. In addition, all our commentaries are always available on our website, and that is 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.